All right, it's 5:30 in Perth, 7:30 Eastern States. We're going to get cracking. Just wanted to wish you a very good evening and welcome to our Property Powerhouse webinar this evening. You can see big and loud there on the screen. The topic tonight, the post-budget, how are the property markets going to perform? So really excited, got a great lineup of presenters for you this evening, and we'll get on our way. There we go, our senior economist from ANZ, Jasmine. She's going to be talking to us about what's happening in the economy at the moment and what they expect to be happening. We've got our general manager, Dana Reynolds. Dana's with us tonight. So, good evening to you, Dana. Where are you joining us from this evening? Sorry to catch you on the hop.
Hey, good evening. I'm in Perth tonight.
Fantastic. Thank you. We've also got Sharon Taylor, investment property consultant, joining us. And good evening, Sharon. Where are you joining us from this evening?
Hi, Garth. I'm in Melbourne.
Fantastic. All right. Well, thanks, guys. And we're going to have Jasmine joining us in a little while, but we're going to get cracking with the slides and let's see if I can manage this. Okay. Thanks, Dana, and thanks, Sharon. We'll catch up with you in a little while. Really looking forward to it, guys. So thank you. Just a general disclaimer here that all the information tonight is general in nature, and please don't. You need individual specific advice for your individual circumstances. So please bear that in mind. The information tonight is just education and for some knowledge. All right. So what do we do at Property Powerhouse? By our mission statement, by providing education, support, and experience, Property Powerhouse enables mum and dad investors to buy quality investment properties all around Australia, enabling them to retire wealthy and happy, ensuring them a financially free lifestyle in their retirement. Our main points of difference at Property Power. So what separates us from other property people in the market, people similar to what we do, or you might have heard about buyers agents and all sorts of real estate agents. Well, very importantly, we have four main points of difference. Number one, we work at no cost to the buyer. That's correct. We do not charge the buyer anything, but like you using a finance broker, you don't get charged by the broker. As for us, we get paid a marketing fee from the vendor, so at no cost to the buyer, which is fantastic and something quite unique to Property Powerhouse. Number two, we recommend new builds, and that's very good for the negative gearing tax deductions. And negative gearing tax deductions are very important for your cash flow on a property week by week, month by month, year by year. And the 50% capital gains tax discount when selling a property still applies. So we'll hear about it through tonight's talk, but as you know, there's been a lot of moving parts in and around the property. The budget threw out a few different curveballs there, but the new builds is what we operate in exclusively and have done for a very long period of time, has come out the winner regarding that. So yeah, very good for investors to be buying in the new build space, and we'll talk that through tonight. Also, another point of difference, we have an Australia-wide footprint of quality investment properties. So mostly in the capital cities around the country, but also secondary main CBDs in and around the country too. And we have decades of experience among our team here. So we know what we're doing. We've been working exclusively in this space. So yeah, you can't buy experience, and that's what we bring to the table is many, many years of experience in the investment property space. So I'm just going to move that out of the way. So yes, lots of different things going on in the market at the moment. Hasn't been a normal market there, as you know. Some of the capital cities have been performing well, others hadn't been performing quite well. We had the federal budget changes, which have had a lot of people confused, even owner occupiers as well as investors, vendors, a lot of people confused. Then we'd be waiting on the RBA, Reserve Bank of Australia, to give the announcement, which they did yesterday, with the markets staying steady. So in markets like this, you need expert advice. Otherwise, it's very easy to make a mistake. Anybody can go and buy a property and get the finance, but is it the right property? Is it the right structure? Is it the right finance? Property being a big value item, if you don't get it right, the cost of stamp duty and trying to unwind things is very, very expensive. All right. So you can make very expensive mistakes if you don't have a great team around you. So at Property Powers, we will surround you with a team of experts who will advise you, guide you, and support you. Right. So that's going to give us our segue now into our first presenter, and that is Sharon Taylor. So I'm just going to move to the next slide. Good evening again, Sharon. And if you want to unmute yourself and you can say good day to us there. All right, Sharon. I'm just going to give you a quick intro there. So Sharon Taylor, she's an investment property consultant with us here at Property Powerhouse. Sharon has over a decade of property investment, being in the property investment industry. Sharon is passionate about helping people create long-term wealth through smart property decisions. Her background spans property strategy, acquisitions, buyer's agency, research, and client advisory, giving her deep understanding of both the numbers and the people behind every investment decision. Sharon has personally invested across 4 Australian states and loves combining her practical investment experience with strategic guidance for her clients. Known for her honest communication and relationship-first approach, she enjoys helping clients feel educated, empowered, excited about building their property portfolio. So over to you, Sharon, and good evening again.
Oh, thank you, Garth. Now let's see, after all of that great introduction, if I can actually work the slides. It doesn't seem to be moving for me though. Is that
Just
my
try and
end?
move an arrow left or right or up or down. Let's see what happens. I have made you there. It should be okay. All right. Otherwise, I'm quite happy to run the slides. I'll
Yeah,
run the slides for you
you
then.
run the slides. Thanks, Garth.
Cool beans. Let's go. All right. Take us away.
All right. So, you don't know what you don't know. It's one of my favorite sayings in life in general, but especially true when it comes to investing, I believe. Property Powerhouse is here to cut through the noise for our clients and hold their hand through the entire buying process. And this is what our team do passionately, day in and day out. Thanks, Garth. And we do this by giving them access to our carefully curated circle of safety, because it's not just about buying a property. As Garth said, that can be the easy part. Anyone can jump online and buy a property, but to buy a quality property that maximizes capital growth potential, performs over the long term, and is a stress-free buying process, that can be a different story. Thanks, Garth. So every aspect from the market and property selection through to settlement and beyond is covered. So let's go over each one. Thanks, Gar. So firstly, finance. Property Powerhouse carefully selects expert finance referral partners to work with. So we're confident that our clients have finance in place and that not only allows them to purchase this asset, but also has a forward-thinking plan that allows them to continue investing and growing a successful portfolio, if that's their goal. So poor finance structuring is one of the biggest reasons investors fail to be able to buy again. This is why the right mortgage broker is essential. Thanks, Gar. So property selection. Once finance is established, selecting the right property is obviously the next step. There is no cookie cutter approach at Property Powerhouse. Each client has their individual goals, timeframes, income, borrowing capacity, and of course, risk appetite. So with this in mind, Property Powerhouse takes the time to understand each client and their needs in order to be able to tailor property recommendations for each unique client. Market, property, and pricing due diligence are imperative, and our research and acquisitions team are experts in this. Their days are spent analysing fundamentals such as supply and demand, affordability, confidence in the market, infrastructure investment, population growth, demographic trends, vacancy rates, rental growth. So we leave no room for guesses or maybes for our clients. It's strategy, years of collective experience, and a team of experts that our clients get to leverage to help them make informed investment decisions. Thanks, Gar. So next we've got, after selecting a property, attention shifts to protecting our clients legally, and conveyancers play a critical role in this. They're doing this by reviewing contracts, conducting legal searches, ensuring compliance, identifying legal risks, and managing the transaction right through to settlement. Small contract issues can become very expensive if overlooked. So an additional layer of protection offered by Property Powerhouse is recommending conveyancers who are also quality property lawyers. And in most states, we've been able to negotiate for contract reviews to be free of charge for our clients, and this can save them thousands. Again, the objective is simple: reduce risk and protect the client. Thanks, Garth. So building inspections, minimising risk is one of the most important parts of investing, and having a qualified and experienced building and pest inspector can be essential for the pre-settlement inspection. Their role is to identify structural defects, maintenance issues, hidden problems, and all before settlement. So it's a vital role as another cog in our circle of safety. And we have the best in the biz in all the markets we're active in for our clients to utilise. Also, our clients get to take advantage of pre-negotiated Property Powerhouse discounts for their services as well. Thanks, Garth. So settlement is just the beginning. One of the most valuable members of an investor's long-term team is an experienced property manager, and their role can extend well beyond just collecting rent. They're responsible for vetting potential tenants, communication between the tenant and the landlord, ongoing management of the property, asset protection, and of course, cash flow management. A quality tenant makes ownership simple. A poor tenant can create significant financial and, in some instances, emotional stress. The right property manager protects both the property and the investor's long-term cash flow, and Property Powerhouse can introduce our clients to the very best property managers in the locations that they purchase in. Thanks, Garth. Another key risk management measure is having appropriate insurances in place, and reviewing them every 12 months is essential as well. So both building insurance and landlord insurance are a must. And once again, Property Powerhouse can connect our clients with experts in this space and give them access to discounts we've negotiated on their behalf as well. Thanks, Garth. So Property Powerhouse offer ongoing support after settlement for every client. So settlement is often viewed as the finish line. In reality, it's where the long-term investment journey begins. Property Powerhouse's circle of safety continues to benefit our clients well beyond settlement. So we help clients to resolve any issues relating to the property. We help coordinate with professionals if necessary. We offer portfolio reviews. We monitor market conditions and keep clients up to date. And we help clients identify future investment opportunities. So our client relationships continue for as long as the client owns the property. And we hear from our clients that have worked with us to date that they see this as priceless. Thanks, Garth. And finally, we help our clients obtain a full depreciation schedule through one of our trusted experts with, of course, the Property Powerhouse discount. Obtaining a full depreciation schedule helps maximise your tax deductions from day one, and it can help boost cash flow and helps for accurate tax claims. Thanks, Garth. So during strong markets, poor investment decisions can sometimes be hidden by overall performance, but changing markets, though, can expose poor decisions. A poor property purchase can lead to lost capital growth, poor cash flow and financial stress, unexpected maintenance costs, reduced borrowing capacity, even a forced sale, and of course, the opportunity cost of missed wealth creation. So this is why the right strategy specific to the client matters. Having expert guidance, it matters. Having the right team matters. So markets, there will always be something of uncertainty: interest rates, inflation, elections, global events, media headlines. There can always be another reason to wait. But successful long-term investors do not react emotionally. They're following a plan. They're staying disciplined, they're making informed decisions, and they're surrounding themselves with the right experts. So ultimately, investment success isn't about knowing everything yourself. It's about getting the right information, the right time, with the right team around you. And this is exactly what Property Powerhouse's circle of safety is designed to provide. Garth, I'll hand it back over to you.
Well done. That's fantastic. You did an awesome job. So thank you very much, Sharon. And guys, what we're going to do is there should be a bar where you can actually put a chat or some Q&A. We hope that's behaving. So just during the night, please put any comments, questions in the chat. We're probably going to answer those questions at the end after all the presenters. Yes, please just share any questions or any information like that that you would like us to share. All right, I'd like to introduce our next speaker. So, Jasmine, if you're there, you would like to unmute yourself and bring your camera on. And there we go. I'm going to give you the controls. I'm just going to give you a little intro. So, good evening to you, Jasmine. Nice to have you with us. Whereabouts are you this evening? Where are you joining us from?
Melbourne.
Okay, great. All right, great to have you from Melbourne. I'd like to introduce one of our main speakers this evening, Jasmine Zeng. She's a senior economist in ANZ Research. Jasmine is a senior economist there, providing macroeconomic insights and forecasts on the Australian economy. She brings over 14 years' experience across government, consulting, and academia, with a strong focus on monetary and fiscal policy and applied econometric modeling. Before joining ANZ, Jasmine held senior roles at the Victorian Department of Treasury and Finance, Deloitte's Access Economics, and KPMG. She holds a PhD in economics from the Australian National University and is a research associate with ANU's Centre of Applied Macroeconomic Analysis. Well, there's some big words in there, Jasmine, and you sound very intelligent and very knowledgeable about economics. So, a very warm welcome to you. And if you'd like us to take us through the slides, you can see the different slide positions. Take it away. Thank you very much.
Thanks very much, Garth. Thanks everyone for having me this evening. I'd like to begin by acknowledging the traditional owners of the land on which I'm presenting today, the Wurundjeri people of the Kulin Nation. I pay my respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander people here today. So I'll focus on three parts of the economy today. So first, the broader economy and inflation. And second, recent developments in the housing market and credit growth. And third, the longer term supply and demand dynamics shaping the housing market. So let's see. Yeah. So I'll start with inflation because it remains the key issue for interest rates. So if you look at these charts over here, inflation expectations are still a little high compared to where they sat before the pandemic. The relationship with petrol prices is also quite noticeable. You see that inflation expectations move quite closely with petrol prices. So from the RBA's perspective, inflation expectations matter because they can influence how households and businesses think about future price increases. So that kind of explains why the RBA remains cautious, even though inflation has come down a long way from its peak. So moving on to the next slide, we see that inflation has clearly slowed down from the highs we saw a few years ago. It started picking up again late last year and has kind of come back down. But what really stand out in these charts over here is that the monthly inflation pulse has picked up again recently because of the higher fuel prices. The broad direction is still lower, but the path back to target hasn't been perfectly smooth. That means the RBA is still likely going to be focused on inflation risks rather than rushing to a series of rate cuts. So if we look at this slide, I'm just trying to put Australia into an international context. So looking at the chart on the left, you see that Australia's inflation challenge isn't exactly different from the other advanced economies. And on the right, unemployment also remains relatively close to pre-pandemic norms. So inflation has improved, and we haven't seen a large deterioration in the labor market, and that's why RBA remains relatively cautious. So let's turn to households for a moment. We know that confidence has improved from the lows, but it is still fairly subdued if you look at the chart on the left. So if households were feeling generally optimistic about the outlook, we will expect these measures to be much higher than they are today. So what this slide is really trying to say is that things aren't getting worse, but households still appear fairly cautious. So over here, I'd like to talk a little bit about consumer sentiment. So the chart on the left shows that household spending growth has slowed, and on the chart right on the right it shows that confidence remains a pretty useful guide to spending behavior. So I think the key point here is that households have not stopped spending. It's just that they're becoming a little bit more selective. People are still spending money, but they're thinking more carefully about where that money goes. So this slide, I'll go through it really quickly. It helps to explain why households are cautious. Real wages, as you can see from the chart over there, have improved, and household incomes have started recovering, but sentiment hasn't recovered to the same extent. So, what it means that is that despite having a better income growth, it doesn't automatically translate into stronger spending. So, like what I've mentioned before, households still appear quite cautious because I think that's quite reasonable to think so. Because after a period of higher inflation and high interest rates, households like you and me would be a little bit more cautious. Um, However, one thing I'd like to highlight is that there is a difference between households being cautious and households being distressed. So, what we can see from this chart is that households are saving a fair bit. So, their balance sheets are actually in reasonable shape. So, you see that they're actually, the growth in household deposits is actually quite extraordinary. So, the issue isn't broad based stress, it's just that households are being really careful right now. So let's turn to the labor market. So the labor market has definitely cooled compared with where we were a year or two ago, right after the pandemic. The unemployment rate has drifted a little bit higher, as you can see from the chart on the left. But I wouldn't describe the labor market as weak. It's probably closer to balance than it was before. And that's one reason why household income growth has remained relatively resilient, because the labor market has helped out. So one thing, okay. Sorry. I'll just skip that. Yeah. So one thing I'd like to highlight is the role of government spending. So you see that fiscal policy remains supportive of activity. Over here, that support is helping sustain growth and employment, even as households become more cautious. From the RBA, that also means demand in the economy remains reasonably well supported. So I'd like to turn now to the housing sector. So over here, you see that this is an important slide because it shows that the market was already losing momentum before the recent policy changes. So looking at the chart on the left, you see that clearance rates have started easing, although it's kind of picked up in the recent 1 or 2 weeks, and I think heading to spring as well. On the right, investor credit growth was beginning to turn as well. So the housing slowdown was already underway. So this slide kind of looks at the impact of the recent budget changes. Our assessment in at ANZ is that the long run effect on housing prices is likely to be fairly modest. What's more important in the short run impact on behavior and sentiment. I think that's what we're seeing here. So housing markets are often influenced by expectations, and expectations can change much faster than fundamentals. So as I've said before, looking at the chart on the left, clearance rate have now been below 50% for quite a while, and that's a pretty clear signal that the market has softened. The chart on the right shows why we pay attention to clearance rates, because historically they have been a useful guide to where housing prices are headed over the near term. So there have been some signs of stabilization recently, but overall it's still quite a soft housing market. So you see that the weakness is most visible in Sydney and Melbourne, but all the other states have started recording some price falls. The chart on the right shows that shows a connection between the housing prices and interest rate expectations, and they move quite in line together. So housing markets are responding not just to the current cash rate, but also to expectations where interest rates might go next. So if you let's move on to the next chart. So what stands out here is the difference between the two charts. New listings are broadly behaving as you would expect seasonally, but total listings have increased noticeably relative to the longer run average. So it does mean that properties are taking longer to sell and stock is accumulating. In simple terms, it means that buyers have now more choice than they did a year ago, and that tends to reduce upward pressure on prices. And here, this slide talks a little bit about why we are a little bit more cautious on housing credit. The key thing to focus on is the gap opening up between investor and owner occupier lending. Investor credit growth has started slowing. Um, in our latest forecast, we do think that investor credit growth might slow a little bit more. Moving on to the next slide. Sorry. Yeah. So this slide kind of pulls together our current house view from ANZ of housing price. So we think that housing prices would continue to come down a little bit. So this year and next year, and that will leave prices around 10.6% below their peak. So the reason I also like the chart on the right is that it provides some perspective. Even with that decline, real housing prices would still be well above where they were a decade ago. So I think we got to take things in perspective that even though there is a decline, it's still housing prices are still way above what they were a decade ago. So we are talking about housing correction here, not a housing crash. And the broader supply story hasn't gone away. Okay, so I wouldn't spend too much time on the detail here. The main point is that different parts of the market are behaving differently. So we've got housing prices by price quartile over here. So you notice that the lower quartile price tiers, I think the chart on the top left, you see that lower price tiers continue to show stronger and more resilient conditions than higher price tiers across most of the capital, although it has started recording some minor declines. So the pace of adjustment varies across price segments. So a similar point here applies. There are meaningful differences between regional markets as well as capital cities. The slowdown isn't occurring to the same extent, but broadly speaking, conditions have softened across most markets. Okay, so here shows another layer of that variation. So houses and units don't necessarily move together. You see that affordability, borrowing capacity, investment demand all affect these segments differently. So what we are saying here is that there is increased segmentation between the different different markets between like units versus houses. Okay. So looking across the major capitals, there are still meaningful differences from city to city. Softest conditions remain concentrated in Sydney and Melbourne, while other capitals have generally been a little bit more resilient. And over here, you see that the smaller capitals have generally held out better. But even so, momentum is easing compared with where it was compared a year or two ago. So difference are really about the degree of slowing rather than whether a slowdown is occurring. Okay, so I think this is really important chart over here. So at the end of the day, supply and demand matters because looking across the states, the common story is that dwelling supply hasn't kept pace with population growth. And that's really what sits underneath a lot of the Australia's housing challenges. But so it makes it difficult to think that housing prices would continue to decline for a long time, because eventually we need those houses, and those housing supply needs to catch up with demand as well. Over here, I won't really go through it, but the experience varies from state to state, and the broader pattern is fairly similar. Some markets face a more acute housing shortage than the others. So if we move on, so supply and demand versus prices. So this slide kind of brings supply and prices together. Interest rates matter, sentiment matters as well, but over the long run, it's the housing supply and the availability that matters. Markets where supply has struggled to keep pace with demand has generally seen stronger price pressure. Whereas if you look at Melbourne market, there's a little bit more supply, so it has kind of helped with the pricing pressure. So on this slide, I would like to talk a little bit about the lending activity. You see that across the charts, you see that housing credit growth is slowing, investor activity is easing but remains high. So, but conditions remain well above the levels we would normally associate with housing market stress. So, I think I'll finish off here, because this slide ties a lot of the themes that we have been discussing. So, if you look at the chart on the left, what I would like to say here is that construction labor demand remains in very high demand. And the chart on the right shows that there is a very large pipeline of projects competing for that labor. So even though the housing market is going through a cyclical slowdown, the capacity to add new housing remains constrained. So if I have to leave you with three observations, is that first, housing conditions have clearly softened. Second, credit growth is slowing across housing occupiers as well as investors. And third, Australia's underlying housing supply constraints haven't gone away, so we will still continue to be building houses, and we'll still need houses. That's all from me now. Thanks.
That was excellent. Thank you very much for that, Jasmine. I'm just going to see if we've got any questions. Guys, let's have those questions coming through, and Jasmine will answer those at the end. But fantastic. That was really, really interesting. I'm just going to try and get these slides to move. And there we go, over there. All right. I've been so busy introducing all the other people, I forgot to introduce myself. So my name is Garth Davis. I'm the founder and CEO of Property Powerhouse. Love our work, love our job, love helping people, love working with clients and helping them build their portfolios, especially when they're buying multiple properties and when their children start becoming investors as well. So yeah, we love that. We love working with our very carefully selected builders and developers. So yeah, I'm going to just run through a couple of slides there. What I picked up from Jasmine there's some really, really good information, but the really strong message coming out there's absolutely markets within markets. So we see all the headlines, the press love it, market prices in free fall and all that. But understanding the different cities, the different locations, and the different markets within the markets. Now, that's what we're really good at. And our next presenter, who will come up in a couple of minutes, Dana Reynolds and her team, that's what they spend all day, every day looking at. And what I also got from got the message from Jasmine is that lower quartile, which what does that mean? It means the bottom quarter prices across the range. So it's your affordable properties. Those markets are holding up the best, and that's because the demand has been driven by first home buyers and investors, right? That market is strong. What we're finding in some of the other capital cities is the sort of medium prices and the high-rise properties. There's less demand. That's where there's softness. And because most of the sales are happening in that lower sort of price point, so are the medians coming down. So you've got to understand what the headline numbers mean. And we know that in the market where we are searching for investors, probably that under that 750, under 800, good properties are still selling very quickly, and we're missing out on opportunities there. So this in front of us now, the screen. So look, There's been a lot of things going on. We've had the 3 interest rate increases this year. We had the federal budget. We had then the announcements of the self-managed super fund changing. And then we had the Reserve Bank announcement yesterday. Now, even within a day of the Reserve Bank keeping things on hold, we're starting to feel even a difference in confidence. And that's all the market. It's been stuttering. And that's because people were very unsure what's going on with these tax changes and with the interest rates, and already seen within a day that just the different conversations we're having with the finance brokers and their clients, and what's going to happen now. The dust will settle, and there will be more confidence in the market. We're very excited about this market because what you see on the right-hand side, opportunity, that's what we see in the markets like Perth, Adelaide, and Brisbane, where it's been really difficult to get stock and difficult to get properties. Now we're going to see availability of a bit more quality properties and quality buyers. And that's what we love. When the market's in equilibrium, there's what we're getting is fair, good value. We're not chasing a market and it's like you've got to put your contract in by 2 o'clock today or you're going to miss out. And we also don't like it when the economy is in a big, massive recession. So this is actually a really good spot now for investors because, the market is more stable. You don't have to panic. You don't have to rush. And you're going to be able to see things out a little bit clearer now that we've got these federal budget behind us. We've got the tax changes behind us. And now it's going to be a level playing field now and knowing where things are going. So let's have a look at the next slide. All right, this is important to see. I'm just going to move that out of the way. All right, so there's challenges all the time. In our lives, there's always something going on. There's always a crisis after another crisis. Every few years after a crisis, there's another crisis. But you can see what happens with property. And if you look at the trend line generally, look, it's a straight line. There's a few times it goes sideways, a couple of times a few dips. But generally, property performs well and it's resilient. It can perform through all these challenges. Look what's happened over the last 100 years. Great depressions, Korean wars, recessions, oil crisis, Gulf wars, 9/11s, GFC. You had big increases in interest rates. Then you had COVID again. Not again, but you had COVID, war in the Middle East, and again, the budget changes. So it's never going to stop. There's always going to be something happening. We can't control interest rates. Interest rates go up, interest rates go down. You and I, as individuals, we cannot control that. But what you've got to do is you've got to have a strategy, and you need to stick to a long-term plan. Property is a long-term game. And you need to have your strategy and you need to stick to it. And there's going to be these things going on, a lot of noise, interest rates up, interest rates down, market prices going up, going down. And our job is to help you time the market so it's time in the market. If you can hold for 10 to 15 years, you're going to do really well with property. And we see this as absolutely a great opportunity now where you're not anyone in Perth, Adelaide, and Brisbane know you've just been scrambling and you've been outbid and people have been paying above odds because they had to. And this market now allows you to make, just good educated decisions in a level playing field where there's a bit more stock, a little less competition to make good decisions. But this slide is really important to remember. Look at the trend line of the properties going up through all these different challenges. As you guys know, I like to just have a look at these numbers every month. This comes up from CoreLogic. And what this is telling us is that the markets, again, it's not straightforward. Some of the cities are up, some of the cities are down, but the market's coming into, as we sort of say now, into a bit of equilibrium. The property markets that were really strong. The rate of growth is slowing. So Perth was very, very strong. You could see 20% over the last year. It is slowing now. Brisbane, that was at 14%, is slowing. And the Adelaide market, where is she there? She was also at 10%. So those markets are changing. We're seeing also great opportunities coming from these other markets of Sydney and Melbourne, where they've been minus for a while, but everything works in cycles. They're not down all the time and prices are not up all the time. And it works in normally a 5-year cycle of growth. And then there's a period of time thereafter where values flatline. So it's always good to see what's happening in the market. And the market now is lots of markets within the market. Just wanted to show you this too. So even though confidence might be a little bit low, everywhere around the country, rents are performing very well. A vacancy rate, so this is this column here, in a healthy equilibrium market, it would be at 3%. So in most capital cities, 3%, there's enough people renting and there's enough properties to rent and it's stable. Look at all these numbers. They're half. These are even like a third. So what that means is there's definitely not enough rental stock to meet the rental demand. And with the government changes now, with the negative gearing, and that it's actually encouraging less. They've tend to have sort of chased off some investors. And what that means is rents are going to be going up. So if you're looking at it from a yield perspective, this is actually, it's very good for an investor. It's unfortunate for the people that are renting. But again, that's out of our control. Those are government policies, government decisions, but these will actually tighten. So what you're going to see is these vacancy rates will tighten, and you're going to start seeing rents go up. And that's across the houses, and that's also across units, which is qualified for apartments and for townhouses. And again, you can see what's happening. 3% should be at equilibrium, and you can see every single capital city here is short and below an equilibrium market. So vacancies that'll be pushing rents up again. So there's some good news on that side that rents will keep performing up. And again, they work in cycles like property prices. They don't always go up, but when it's driven by demand and supply, like Jasmine was saying. And as long as the supply cannot meet demand, there'll be pressure for that to go up. P&I stands for principal and interest, and IO stands for investor only. So these are some different scenarios for investors. Looking at about an 80% loan LVR, stands for loan to value ratio, which is what a normal loan would be at. And what we can see here is that generally, there's not a lot of movement over the 3 years. They actually expect it to sort of be sitting where the variable rate is today. So we're probably in a new regime now, in a new climate where this is the interest rate. So trying to wait for interest rates to go up or to go down is probably not gonna, or time it for interest rate. What you need to be doing is talking to your finance broker all the time, discussing things like, should we fix rates? Should we keep them variable? What's the right strategy? Should we split that? So talking to your finance broker is fantastic. They are awesome people. Make them your best friends. They will help you understand your borrowing capacity. They'll help you understand if you've got equity in your property. They'll understand if you've got serviceability, which means you've got enough wages, and start having those discussions with them about your current situation. Can they refinance you for a better interest rate to save you money each month? Would you be in a position to buy an investment property if you wanted to go that way? So definitely be talking to brokers, finance brokers all the time. All right, I'm going to introduce our next speaker now, who is Dana Reynolds. So Dana, very good evening to you. If you want to just come on, I'd like to do an introduction for you. So Dana is the General Manager of Property Powerhouse and is of the property research team and stock acquisitions. Dana has been in the Australian property industry for over 15 years and she is an avid investor, developer, renovator, and is a real estate licensee. Let me just give me a second here. And she is a licensee with specialization in new developments nationwide. Prior to joining Property Powers, Dana was a developer's master agent for the beautiful towers at Elizabeth Quay in Perth. As the head of research for Property Powerhouse, Dana has extensive teams spend their time reviewing, assessing investment property opportunities Australia-wide, searching for top quality, low-risk opportunities for our clients. So I'm just going to see if that it should be working now.
It's not. Oh, there we go. Let's see.
Okay, there we go. Don't blame me, Dana.
All right.
Okay.
Here we
There you go. You drive. All right, and a very nice warm welcome to you. Yeah,
there we go. Hi everyone. So nice to be here and speaking with you guys tonight. Not to rehash what everyone said, but a balanced market is definitely not bad news for buyers. From my side, it gives us a lot more control, a lot more room to do proper due diligence. Not that we're ever short with our due diligence, but just more room and space and a little bit more time. We're seeing the changes on the ground from the developer. We're seeing more choice come through from markets that we haven't seen opportunity in a long time. It means we can be more selective and there's more opportunity. We also have a lot more leverage than we had before in certain markets. These longer selling times create room for us to negotiate terms with developers. So in really hot markets, land developers weren't even considering giving giving finance terms. And that verbatim has really changed over the past couple of months. So that's really exciting for our clients, because a lot of what me and my team do at Property Powerhouse is sort of evaluate risk. And if we can't get finance terms for our clients, that is a huge risk factor, because it's all well and good in rising markets, but when things change or if you get a bad valuer, there's just risk in that side of things. So what we're doing is looking at all the risk in these deals and just trying to get rid of sort of most opportunities that sort of don't meet all of our very high criteria. But back to the market, it also gives our buyers more time to think. I don't want to say that we're ever imposing pressure on people, but the market was previously imposing quite a lot of pressure because we had no control over the properties. There were just too many buyers saying, right, I'll pay cash right now, let me have it. So no seller would ever hold it for someone who was like, I want to think and talk it over with my wife, or wait till next week when my broker comes back from his holiday in Nepal. Like, that was just not options that we could give people. But now we have a lot more opportunities. So the big story is that we do have a lot more control to find those opportunities out there. Where am I? Sorry, I'm looking for my controls. This is the first time I'm driving, so bear with me, guys. And as more opportunities are opening up, we know that they're not evenly spread across the market. So in Perth, it's really exciting. I've seen a couple of packages on titled blocks. That's something we haven't seen in years. Land is so tightly held. And we've even seen a couple of nearly completed houses as opportunities, which again, for many years was really nearly impossible to find, a unicorn, as my team likes to call them. In Brisbane, more land is becoming available and the contract terms are becoming more favorable. In Melbourne, the lower end is still definitely moving quickly. So price and product selection matter a lot. So we think this is all a very good thing. Let's see how this page. All right. So everyone wants to know sort of what my team is doing, because we're always talking about the research that we do at Property Powerhouse. And again, I think the research really focuses on the risk in the deals. And so we like to sort of find reasons to strike a deal or strike a property off our sort of watch list. So today I thought we'd deep dive a little bit differently. Instead of why we like a property, why we ultimately didn't like a property that we thought we would really like. So this is one property that we researched maybe a couple weeks ago now. It's number 22 Pendale Street, which is lot 123 in Solara Estate in Tarneit, Victoria. It really looked promising. So it was a house and land package, 4-bed, 3-bath, and a dual key, which is a new sort of type of property that we're starting to see in Victoria. Previously, we weren't seeing it in this market. So our initial due diligence, the property passed the sort of high level checks that we do. We do a location and a site screen, like a high level one. Is there anything nasty about the site that's an immediate no? Is there a graveyard right there, or a power substation, or a barbed wire fence? We've seen all sorts of things. So it passed that. The pricing looked fair enough for the market, so that was an immediate no. And the land was titled, which is something that we're always looking for on the risk side of things. So tick, 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 we're okay here. So we dive a little bit deeper into the property. Have I lost control, Garth?
No, you should be good. I'll move it for you. There you go.
Oh, there you go. Sorry, I think it's so light. I didn't see it. Okay, so Tarneit is an interesting market. It's kind of an old suburb, a really established suburb, which has all of the schools and all of the infrastructure, but it's also a new and growth suburb. So it's kind of a growth corridor and kind of an established corridor. So you really have to know this suburb, and it's very, very big. So you really need to know the suburb to really sort of understand, which part it's at, and these kind of micro markets. So Solara Rise is a tiny private 95 lot subdivision. It's on the north side of Doherty's Road, which is between Davis Road and Tarneit Road. It is alongside existing residential subdivision, and there is road infrastructure in place. So it already has access to all of the major established amenity, which is like Turnmeet Station, easy access to the Westgate Freeway. You've got some of the major shopping like Turnmeet Central, Turnmeet Gardens, Riverdale. You've got the schools and the parks and the childcare. But it's also quite close to the Turnmeet North, which is the future upside. There's a huge town center coming, a massive employment hub, a new train station, lots of infrastructure. So it kind of gets the benefit of both worlds because it's already got the access. Okay, so tick, we'll move on. Don't have to sell you on the location, but we were happy with everything that we saw here. So, oh. All right. The builder. The builder is a builder that we really know and love and trust. We know the owner of the builder. We know the relationship that the builder has with land developers. So he really has his finger on the pulse on all of the earlier sides. So that helps from a risk perspective for me to feel comfortable in the overall structure of the deal. It's also, they're very flexible with our clients with their finances. So, for example, this builder will allow us not to take any money for the build up until land settlement if I ask him. And if they do take anything, it's fully refundable. So things like this, it's a builder that builds quickly, is architecturally designed homes that are stunning with inclusions and high ceilings and high windows. And I could just go on and on, but okay, we love the builder. So another, tick, we're happy there. Okay, so the fact that it's dual key is really the interesting part because, again, this is new for Melbourne. So this design was a 3-bed with a 1-bedroom auxiliary residence, but genuinely under one roof. So we call these dual locks, not sort of a granny flat configuration. And where Garth is kind of highlighting is that ancillary dwelling in the lighter mint green, and the main dwelling is in the darker green. So the ancillary dwelling is like a tiny apartment. It is about 47 square meters, I think it is. So not massive. And the house does have to give up a little bit of space to have the dwelling based on the zoning regulations and so on and so forth. So there's good and bad. The main house gets smaller, but you do have the potential now for 2 income streams. Generally, this should bring much higher yields. So that's why it's a very interesting property for us because we're always looking for the best cash flow for our clients. When I'm thinking about risk, I'm also thinking about long-term risk. I'm not just thinking about risk in the buying of a property, but really the risk of owning the property long-term because we're really encouraging our clients to get into properties that they should hold. I mean, for me, I want to hold all my properties forever. So or I want to hand them off to my kids. So I'm really looking long-term. I want to make sure that the property meets the market. So you have to consider like all the sides of it. So you get 2 income streams. It does change how tenants look at the properties, obviously. Like for the main dwelling, it now isn't a standalone property with its own yard. It is an attached dwelling. And the shared structure will also change the resale pool. Now, for the right properties, that's amazing. I would love a dual income property. This one, I don't know that as an owner-occupier, I would necessarily live in something like that. So I'm considering all of these things. But for an investor who's just looking for rents, I mean, there's nothing wrong with the house. The bedrooms are pretty decent size. You have the 2 beds, you have the 2 baths, you have a walk-in robe. There's nothing blaringly wrong with the layout. So look, it's okay if it gets the yields and someone can therefore cash flow it, right? Better to own a cash flowing, appreciating asset than nothing at all. So we look further. Okay, just to give you an idea of the actual details, it's $813,750 for the full package. That comprised of $375,000 for the land. Land was 315 square meters, very good value there. The build also an excellent price for a dual key at $438,750. Build size 181. Yep, everything looks good. So we're targeting the return of 5% plus. And this is where things kind of started to unravel. And I want to really talk about and just praise our property managers out there. We have some amazing property managers, and they a lot of what I do is actually talk to them and call them up and say, hey, so and so, like I have a property in this area. Can you have a look at it? What do you think it's going to rent for? We do it on actually every single property, is get a bespoke rent appraisal from property managers that we trust, or at least like 90% of properties. So yeah, they're amazing. So in this case, I went to Mark, who's in Melbourne. Love and trust Mark. You know, he does the comps every single property we sent him. And so his letter comes back at 620 to 650. We pop it in the system and look at the returns, and it's like 4 to 4.2. Like, did he make a mistake there? It's a bit weird. Like, it's just not what I was expecting to see. Okay. So call Mark. And I say, hey, Mark, like, is this actually correct? There we go. And so we asked him to split up the rent and explain it to us, like how the main dwelling was going to rent, how the extra dwelling was going to rent, like what was going on here. So he basically said, look, we could probably get 460 to 500 for the main dwelling, which was a little bit lower than you might get. And I was a little bit surprised. And he said, look, you know, there's a lot of stock in Tarneet right now. Tenants have choice. And so when you're looking at something that is attached, it's less attractive, and it's going to not get a premium rent to something that's standalone. You know, so this is, if you want it to rent, this is really the range that we're expecting on it. And he said, and when you look online and you look at all these fancy numbers, like with these types of properties, and particularly with the auxiliary dwelling, you'll see them like $250 a week and things like that. Those are often furnished. And so then that comes with whole other things. So he said, you know, just a standard house, this is really what the numbers look like. So, okay. Now we're looking at 4 to 4.5%, still not really hitting the mark. So I called another property manager. She said, like, just want to toss this back across someone else, you know, see if this is really correct. He said, nah, bang on. You know, there's tons of comps. Absolutely. This is the range that we're looking at. So, you know, is this a good property for our clients? Well, I mean, there's all the downside of this in terms of capital growth. When you want to resell a property, you're targeting an owner occupier more often than not if you can, because those are the types of buyers that are, you know, buying with their heartstrings and, you know, all emotional and might overpay in hot markets and this sort of thing. So you don't want a property that doesn't appeal to like the masses of them. Once you have a second dwelling, you have 2 management fees, you have 2 sets of insurances, you have 2 sets of maintenance, you have 2 potentials for vacancies, you have all those sort of things, 2 sets of inspections and on and on. So there's a lot of things to really consider when you're looking at the deal. And for a rent of 4 to 4.5%, honestly, we can find that for you in Melbourne with like a single dwelling in a very happy family suburb, you know, in a great location. So, you know, this is a property that we decided not to work on. Yeah, that's kind of the process that we went through on this one. And we really, again, are just so grateful to those PMs for helping guide us sometimes in these micro markets and really help us see what the long-term picture is going to be for everybody on these opportunities. So, all right, I just went through that. Yada, yada. We'll move on. If I can get this to work. I guess good investing is often about what you say no to or the deals that you don't do. You know, these balanced markets, they give us more opportunities. They give us luxury of time to really just comfortably do all this due diligence and, you know, make sure every property that's paired up with a purchaser is paired up properly. So, it's all about long-term, low risk, good investments. And I guess just for my 2 cents out there, obviously, this is not personal financial advice or an offer. Here's my disclaimer. Look, there's just so much negativity out there. And I guess people like me, like I don't build my strategy around the noise. I don't get caught up. I have a no news in my house policy because I think everything's bad for my kids to hear. I do love to read the news, but We don't watch it. Look, I have a very deliberately boring approach to my investing. I buy good assets when I can afford to. I keep the risk low. I hold for the long term, and I watch them go up. I know where I want to go, and so I'm going there, like without expecting to like leap bounds. I know I'll get there comfortably, and let the good assets do the work for me. So yeah. We always joke, what happens to my vanilla ice cream? We're always joking in Property Powerhouse about vanilla ice cream because it's like we just want these vanilla deals. So I swear I had a vanilla ice cream on my slide. But that's it. Like we always just like, is it vanilla enough? Like, is this house just like plain old vanilla? There's nothing weird about it. Like we just want these, really low risk, quality vanilla properties. Great houses in great little pockets of suburbs that will rent really easily to very normal people, hassle free, and sell. When the owner's ready. So, yeah, nice to speak with you all. Thank you for having me.
No, great, Dana. Thank you very much. Always great energy. We do have some questions. Sorry, I think we might have just lost Jasmine in the maybe in the feed. So I'm going to see if I can try and get it back on. But a question here from one of our attendees, Mark. Hi, Jasmine. Great talk. Just wondering, you showed the chart regarding prices and fuel prices, and the chairwoman of RBA mentioned fuel prices and it's affecting internally, but being passed on to consumers, therefore adding to inflation. However, are not these extreme fuel prices like an interest rate rise taking money out of the spending of the populace? And why does the RBA not take such ordinary items out of the inflation rate, as it's not reflecting prices rising due to demand, inflation being artificially increased due to these? So look, I don't think I've got access to, I'm just going to see whether she is, maybe come back into the room. Yeah, Jasmine, let's just see if I can get her back in. But basically, yes, Mark, it is badly affected by
She's
that.
back.
Jasmine, yeah, I think we just get her to unmute. Jasmine back. Can you hear us, Jasmine?
Yeah,
There you
yeah.
are. Okay. Much better for you to answer that than myself. So I don't know if you heard the question, or if you'd like me to repeat it.
Yeah, if you could briefly repeat, that would be great. Sorry.
Okay. Just wondering, you showed the chart regarding prices and fuel prices, and the chairwoman of the RBA mentioned fuel prices and it's affecting prices internally, but being passed on to consumers, therefore adding to inflation. However, are not these extreme fuel prices, like interest rate rises, taking money out of the spending economy of the populace? And why does the RBA not take such extraordinary items out of the inflation rate, as it's not reflecting prices rising due to internal demand? Inflation has been artificially increased due to these. So I suppose what he's saying, that's not you and I going out and willy-nilly spending our money. These are forced inflation upon us. So what's your answer to that, Jasmine?
I mean, at the end of the day, supply shocks do affect a small open economy like Australia. So a lot of the things that we use and power is driven by fuel, and which is why the inflation actually takes into account of that. And ultimately, inflation, fuel prices affect uh, how much things cost to build, and how much, and then that flows on to consumer prices, and eventually that flows on to wages, which is why the RBA has to consider the whole chain of impact from fuel prices.
Wonderful. We've got a question from George. Thanks, George. In regards to medium house prices and drops in them, can you give insight into how this is calculated? If the medium house price is, say, 900,000 and most of the sales are below this, because as you indicated, the low end of the market is still strong, the lower quartile, and high price values are not being listed due to it being a soft segment. So will this not cause a drop in prices even though the low segment prices are rising?
So if you look at I mean, if you record the chart there I showed, it shows that the lower quartile prices are performing a lot better than the other two quartiles. But while it's performing better, we've seen that the lower quartile has dropped off a little bit at the end, but not by a lot. So I mean, prices are declining across the board, but the bottom quartile is still doing a lot better than the rest. So it's kind of a cyclical slowdown, and eventually it will bounce back up again.
Fantastic. We just got some feedback. John McMaster from Queensland, one of our referral partners. Good stuff, Garth. Look forward to putting some more clients into quality investment properties with you and your team's expert help. So really good. I don't know if we've got any other questions. Sorry, I didn't mean to move that one forward. Don't know if we've got any questions from anybody else. Let me just see. I think I've seen another question come through. So it's a great opportunity. If you have got some questions, let's just see Q&As. Okay, I think we got them all. But look, the call to action from tonight is the markets have been fluctuating. There's been a bit of stuttering. Now that we've got the budget out the way, we've got currently the interest rates. There'll be no changes now for another 2 months. We're going to get to spring. There's more confidence in springtime. There'll be more buyers in that time. It's a great opportunity just to get an understanding of where you are at. So the call to action is go and speak to your broker. Number one, see are you getting the best interest rate. Bank business is actually have slowed because of this environment. Therefore, banks are looking for business. They're looking to refinance. So speak to your broker. They are awesome people. As I mentioned, a lot of them work at no cost to you. If you don't have a good broker, reach out to us at Property Powers. We have a network Australia-wide of trusted investment property partners. So get a second opinion on your finance. See if you're on the best rate, best loan, and ask the questions. Look, if we were in a position to look at buying investment property, whether it's now, in 2 months, in 6 months, do we have the equity? Do we have the serviceability? Are we sort of a candidate for that market? So have a chat to your finance brokers. It's been a good session. I hope you enjoyed the information. You can see that, the media puts a very negative picture on it. I think you can feel from tonight that the market it's a great time because as demand's a little bit out, we're going to see a bit more supply of properties, particularly in suburbs and cities that we haven't been able to get it previously because it was too hot. It's a great time to look at buying. Have a conversation with us here at Property Powers. We will customize the search and strategy for your own requirements and find you the right properties. We don't build or develop anything here at Property Powerhouse, so there's never any conflict of interest, and we do have that, as you know, that Australia-wide footprint. So just wanted to say thank you very much for joining us this evening. Thank you to our presenters, Jasmine from ANZ, Sharon, our property consultant, and Dana, our general manager of research. We will be sending out a recording of this, so please feel free to watch it again. And we will be reaching out in the next few days just to touch base, see if there was any information that you needed extra, or if you didn't want to ask a question today from this. So thanks very much. Have a great evening. Hope we haven't gone over by too many minutes, a few minutes over. But I hope it's been very valuable and educational for you. As always, we never try to sell you one property, and that's what we promise, never to be a sales company. We strictly want to give you education and help you to make educated decisions. Thank you from Perth and the rest around the country. Have a good evening from Property Powers. Thank you.